From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, consumer confidence starts to break, but inflation expectations stay hot. And that's all as investors await CPI data just days away. But we begin with the big issue, the Fed's confidence to cut with messy economic data.
The Fed is looking closely at the data.
It's really looking at the totality of the data.
Inflation remains sticky.
Wage growth sticky, core inflation sticky.
The Fed is likely going to take the right views of the economy.
We think that's going to be higher for longer.
I think later this year we'll get our first cut.
If they haven't cut in September, they're likely to cut in December.
The first cut comes in September and then another one in December.
We're looking for the inflection point.
And I do think that he's looking for a reason to ease.
It's rare that the Fed would intervene before November, right? So will he remain patient through the election?
There's still a question of will inflation actually decelerate enough by then?
As the data come in, hopefully we'll be moving in the direction we want to see, both on inflation and in terms of restoring balance to the economy.
Now we're looking here at a double-edged sword. U.S. consumer sentiment declined in early May to a 6-month low, but short-term inflation expectations and concerns about the job market have picked up. You have to understand that what this means is the economy is softening, but with inflation still high, there is a question on how quickly the Fed can cut, and the current expectation is at least once this year. But if you flip up the board here, look at the credit spreads and the picture that we're looking at. They have collapsed across the board from investment grade to junk bonds, and the extra yield that investors get for owning debt instead of government bonds is the lowest in 2.5 years. And remember, the expectations for Fed rate cuts, now we said just one this year, potentially, that has changed drastically from earlier in the year where there were at least 6 expected. Yet spreads have remained ultra tight. Now, we caught up with Minneapolis Fed President Neel Kashkari on the sidelines of Milken, and here's what he had to say about inflation.
We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%. The second half of 2023 surprised us at how rapidly inflation fell. It seems like it stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
Joining us now is Barry Knapp of Ironsides Macroeconomics and Skylar Montgomery Koning of TS Lombard. Barry, you look at the conflicting signs in the data, some things starting to weaken. Yields this week have been interesting in the shorter end of the curve because even though we saw it go lower last year, we've been wavering around that 4.8% level. Where do you think we go from here?
Well, I like the front end more than the back end. I still think of the 3 most plausible scenarios, one being the most likely, which is that rates move higher still, tends retest the 5% peak that they reached in late October amidst the increase in Treasury issuance of notes and bonds. That's the most probable scenario for me. The last month's employment report, or last Friday's employment report, did open up the possibility that we could get a string of weak labor market data that would allow the Fed to start the easing process, which would, painlessly disinvert the curve, bring the banking system back into all that issuance in terms of them participating in the belly. And then the least probable scenario for me is that we just muddle through and the Fed doesn't cut but rates don't move. I think most probable is that the back end is still going to retest that 5% level.
Now, I want to bring you some headlines also crossing the terminal here because Bloomberg had a conversation with Fed Governor Michelle Bowman, who said she doesn't think that it's appropriate for the Fed to cut interest rates in 2024. And she points to persistent inflation. Skylar, when you look at that prospect, the idea that we may not get a rate cut at all this year, what are the concerns?
Yeah, I mean, I think, for the Fed, they very much want to cut. They've kind of lopped off half of the distribution of what they could do policy-wise and saying that they're definitely not going to hike. I think, the problem is the economic data. The economy is strong. The labor market is tight. And there's definitely greater worries over sticky inflation after 3 months of upside surprises. I don't think we have to get back to 2% inflation for the Fed to cut. I think it's widely accepted that, maybe we get this revealed preference for higher inflation, but we definitely need downside surprises in inflation. We need a clear disinflation trend, so not just 1 month. And there are still plenty of months in 2024, so we can certainly still get 2024 cuts, but it makes sense that the market has pushed out those cuts, and it makes sense that people are thinking about potentially not cutting this year. We just have to see how the data comes in the next few months.
Barry, we've been talking a lot here at Bloomberg about how rent is the last domino to fall, shelter costs. When we think about the inflation story, how sticky is higher shelter costs?
Extremely. If you think about the various measures of rent, the apartment list, which is new rents, or the Zillow Observed, which is more of a blended of existing and new rents, they peaked in mid-2022. Most of the academic research says that it should be about a year lag before it filters into the CPI or PCED measures. Well, here we are nearly 2 years past, and sure, it's come off, but we've lapped the 7-month period where we were averaging something close to 0.75 per month in the core rent of shelter measure. And it still hasn't moved down all that much below 6%. And if you look at those measures on a quarterly basis, they've turned back up along with house prices. So it's very unclear to me that we are going to get anywhere near the 0.25 monthly increases or 3% annualized increase that persisted through the 2010s. I think the Fed did serious damage to the housing market. They exacerbated the structural imbalance by the way that they tightened. Passive QT and aggressive rate hikes caused the deepest yield curve inversion since the Volcker era. So they damaged the supply side just as much as they damaged the demand side, and just made things worse. So for me, I don't think that it's plausible to get to 2.5. And I would further go on to say that Kashkari's expectation that the Fed alone can bring inflation to 2% is not consistent with history, not consistent with the 60s or 70s. We would need a tightening of fiscal policy to bring that non-housing services component down, which is reaccelerated in the second half of last year. So I'm not nearly as sanguine about the inflation outlook as President Kashkari, that's for sure.
Skylar, what is your expectation here? We're just days away from another critical inflation print, and where are you the most concerned that we can still see things too high?
Yeah, I mean, I completely understand the worries over sticky inflation. On the good side, it's been very evident that we keep getting these rises in commodity prices, even if they've moderated in more recent trading. We have continued global political tensions, so geopolitics have, definitely been in the background, and that's meant continued shipping disruptions, and both of those things automatically feed into headline inflation. I think the bigger worry, because of the potential for second-round effects, is on the services side. Wages are, fairly sticky in the 4 to 5% range, depending on what measures you're looking at. And because we've had 3 months of a row in upside inflation surprises, it's harder to get that downside surprise. But what I will say is that in the U.S., there's been a supply side rebuild. So the labor market has rebalanced with job openings declining in the industries that had the highest vacancies. And I don't think higher wage growth necessarily has to be inconsistent with disinflation if productivity is rising. So I think for us, 1Q was very much a bump on the road of disinflation. I don't think we settle back at 2%. That seems more unrealistic, but certainly we could get some downside surprises in inflation from here.
I think about what Carlisle's economist said earlier this week, Barry, and it seems to jive with what you were starting to say a little earlier about long-term yields, rising long-term yields, potentially much higher than what we see today. You see all these investors slamming the duration story. They're piling in really to the duration story. But what's the risk that they're wrong? What's the risk that yields on the longer end of the curve go much higher?
So the brand name for Ironsides Macro is It's Never Different This Time. And I do a tremendous amount of work on past periods. I think the applicable period here to just get a very long-term potential scenario or outlook for the Treasury market is to think about the 1960s, where we were unwinding the rate caps that existed through World War II. Banks had piled into treasuries. It took them 30 years to wind those positions down. We just had a series of higher highs and higher lows as inflation rose along with more expansive fiscal policy through the course of the 60s. And I think that's very much the path that we're on. Having negative term premium on 10-year treasuries is really abnormal. And when you just look at that and line it up with the whole QE era, it's pretty clear that unless somehow we're going back to the zero lower bound because the economy comes unglued, which to me seems highly unlikely with this expansive of fiscal policy, I think we're just headed for higher rates and higher term premiums over time. So sure, we could have a real hiccup in the economy and have a move lower in rates, but I just don't see the policy rate settling in where the Fed thinks it's going. 2.6%. I think 4 is more likely as a sort of a neutral policy rate, and I think rates, the longer end needs to have a term premium in it, and that's where we're headed.
Team, we have to leave it there. Barry Knapp and Skylar, Montgomery, Koning, thank you so very much for your time. Of course, critical economic data ahead. Stick with us. More real yield ahead. This is Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where global companies are seizing on strong demand and lack of clarity around funding costs to issue the most debt in years. Looking at U.S. high grade, there were nearly $56 billion of sales this week, way above estimates. CVS, Charter, and HSBC helping to drive issuance to the third busiest week of the year. The list of sales was robust, as you can also see names like Coca-Cola, UBS, and Hasbro. Monday through Wednesday, each saw 14 issuers for the busiest 3 sessions since 2021. It wasn't just investment grade. The credit party was also seen in high yield with almost $13 billion. Block, Hess, LifePoint helping to push the pace to the best since 2021. And Guggenheim Partners CIO Ann Walsh saying it's a good time indeed to buy credit.
Investment grade credit, great trade right now. Also, parts of the high yield market, particularly the higher credit quality part. I'd avoid the lesser credits. We still have some risk, being rationed at CCC rated credit that I'd be thoughtful about, and you could see some spread widening there. But historically, when the Fed's on pause, this is a good time for credit.
And joining us now is Will Smith, Director of U.S. High Yield Credit at AllianceBernstein, and Dan Zwirn, CEO and CIO of Arena Investors. Will, let's start with you quickly about how you have perceived the last week. There's certainly been a deluge of sales. Have you been a buyer?
We've participated in several transactions where we thought there was good value, but overall being really selective. I mean, this kind of reminds me of, for those of you who are fans of the NHL, we're in the playoff season now, and towards the end of a game, the losing team will attempt to pull their goalie in a chance to score that goal that puts them to tie up the game, but it leaves them really exposed. And it feels like there's a rush here for investors to buy as much as they can, but the risk is pretty great. So you really need to do your credit homework.
So I'm glad you brought that up because, Dan, you were actually quoted really recently in a Bloomberg story, and you said that there's this pretend notion that because default rates are low, everything's fine, but it's not about defaults, it's about recoveries and actual losses, what people miss. What are people missing?
Well, I think as a general matter, banks, insurance companies, and regulators, as well as agencies, tend to focus on defaults and interest rate coverage, or interest coverage versus actual severity in these situations and the leverage that you're kind of taking on when you expose yourself to a capital structure. And ultimately, you can manage and create low default data by simply having very weak covenants. You can create very high coverage data by charging very little, right? Whereas you can't really fake it on leverage and severity.
It's interesting. Dan, double down on that really quickly here because this idea that data doesn't lie, sometimes it does.
Well, I guess the choice of data may lie, right? Ultimately, if you're choosing the wrong data to express a certain thing that it doesn't support, you can get fooled. And unfortunately, historically, people have relied on a kind of more homogeneous way of looking at credit in a way that doesn't necessarily anticipate changes that we've seen in the way people structure and think about credit today.
Will, we were kind of talking about this idea that spreads have remained incredibly tight despite expectations changing here around Fed rate cuts this year. Do you think that's warranted? How quickly can they start to blow out?
Well, it's always the really difficult question to answer. I mean, when spreads are wide, and it tends to be when the economy is weakening, most of the time weakening much quicker than folks anticipate. And that's always a really difficult thing to time well. Now, if you look at high yield in particular, there's really the story of the have and the have-nots. Similar to Dan's point, there's about 4% of our market that's pricing in a very high chance of default or restructuring of some sort. The other 96% of our market trades basically at the all-time tights. And that's concerning to us. And as we talk to investors, most folks are looking at markets and saying, well, I want to buy credit because yields look good, but I don't want to take any real downside risk, and therefore I'm going to crowd into high quality. And what that has done is basically made high quality bonds extremely expensive. It's not to say that spreads are suddenly going to widen, but your forward returns are just going to be challenged. You're not going to earn much more than treasuries if you're buying a BB rated credit at 120 basis points a spread. And what we think that really does is it opens you up to an environment that maybe looks different than the one we have today, i.e. growth slows, or pick your poison in terms of a macro event. And we always like to think about markets in terms of how much money we can make if we're right and how much money we can lose if we're wrong. And the reality is today, most parts of credit, you can't make much if you're right, but you can lose a lot if you're wrong.
Dan, how do you feel about the risk reward?
I would kind of violently agree with that. And I think the point is that you have to define what you're looking at within credit. And so certainly within the tradable markets, both in corporate and ABS, it's super tight, and the compression we've seen between higher quality and lower quality is really very, very low. But that said, there's more than that kind of credit. And so when we look at things like credit within growth enterprises, the embedded kind of credit opportunities available in the secondaries market for LP interests, when we look at the entire market for commercial real estate, there's lots and lots of other types of credit where there is very, very large value destruction that's already happened, and the ability to kind of be a beneficiary of that has already begun.
Will, I feel like, and correct me if I'm wrong here, but the last time we spoke, you were a lot more sanguine about the state of credit, and it feels like something has changed. What has changed for you?
I think it's really two factors. One is just valuations, right? Spreads have continued to grind a lot tighter. And the second is really investor behavior and things that start to look and feel more like animal spirits out there. Folks kind of searching for that last risk premium, if you will. And that starts to be quite concerning, because that means that credit is being extended to areas where it probably shouldn't. You know, the likelihood that bonds are getting mispriced, we think is higher. And we start to get concerned that you're getting late in that credit environment where the chances that you get burned are significantly higher. So those I would highlight are the two major areas that have changed.
Dan Zwirn and Will Smith, we thank you both for joining us on these credit markets, certainly a hot topic.